Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, if you own stocks, you're likely very happy. The market has had a very nice year so far, year to date. So we're going to talk about the market and are stocks overvalued? We're going to dive into that today. By the way, if you find value in this video, if you see it on the socials, go ahead and share it. Or if you get it in an email, go ahead and forward it to a friend. So are stocks overvalued? We will jump in and explore. And as I mentioned, the stock market has had a nice run. In fact, the market is up more than 30% from its early April lows. That is the S&P 500. Now, we've had 28 record highs since the start of the year, thanks to three general things: better than expected corporate earnings, a resilient domestic economy, and the Federal Reserve rate cuts. A lot of positive news. Now, recall, as mentioned not too long ago, around the March timeframe, the market took a large dip around 20% from the peak, and it has had a tremendous recovery, again, driven primarily by these three things. Now, is there some really bad news, potential bad news, that stocks are potentially overpriced? Well, let's jump in and dive deeper. Is that a bad thing per se? It may not be, but stock valuations are now at the highest levels since the dot-com era, according to the CAPE ratio. Now, the CAPE ratio comes from Mr. Schiller that created this ratio some years ago, and CAPE stands for cyclically adjusted price to earnings, which is essentially a valuation metric that compares the current price of the stock market, for example, the S&P 500, to the average inflation adjusted earnings over the previous 10 years. Again, he comes up with a ratio and it ends up spitting out a number. Now, as I mentioned earlier, this is the second highest in history. You see where the peak in the dot-com era, just before the downturn, we had a ratio of around 40, let's call it 43, and now we're at 40. Now, this is not to imply that the past must equal the future. Now, again, we're not suggesting that very high PE ratio means that the party's over and the market is going to start pulling back like it did in the dot-com bust. But I want to express to you that relatively speaking, we're at high valuations. Now let's get some experts' opinion on what they think the market's going to be doing in the future here. The stock market strength is making it tougher to put new money to work, says Rick Gardner, Chief Investment Officer at RGA Investments. And Goldman Sachs, David Kostin, the Chief U.S. Equity Strategy at Goldman, says earnings should remain the primary driver of equity upside going forward. And his position is, over the next 12 months, he sees the benchmark, the S&P 500, that is, advancing around 8% from the current level. And he goes on to say that equity valuations are elevated relative to history, but appear close to fair value based on the underlying macroeconomic and corporate fundamental backdrop. An accommodative Fed and an economy that accelerates into 2026 should allow the market to maintain its current multiple. Let's see if he and others are right. And as it is said, the trend is your friend until it bends at the end. So in other words, the market has had a nice run, and odds favor, short of a pullback here, it likely will head higher. Again, much of it is driven by corporate earnings. Much of it is also driven by a recent Fed rate reduction and an anticipation of at least one more reduction year end. And obviously the market has a theme right now, and that is artificial intelligence. And there's a lot of money flowing into artificial intelligence stocks and opportunities, including the private equity space. So I want to just remind you, you must have, in our opinion, some general things here. Do not lose focus even though you're doing really well. Number one, get clarity on what your goals are. Number two, have an investment plan. And number three, have an investment strategy. Understand your risk tolerance, 10 being very aggressive, 1 is very conservative, like money in a savings account. Where are you on this risk scale? Develop then a growth and protection strategy where you could participate in market upside. But then if we have a bear market or a significant downturn, even like we had in the dot-com bust, your portfolio is protected. So you're not giving all those gains back. And obviously you're not putting yourself at risk. And number three here, understand what your family index number, that is the rate of return that you need to earn now and in the future to live your ideal financial life and live the life you want. All that to say is, if you found value in this video, as I'd mentioned, if you see it on the socials, go ahead and share it, or if you get it in an email, go ahead and forward it to a friend. And to that end, if you would like a second opinion on your portfolio or financial situation, this is our website at nicholswealth.com. Click on this Request an Appointment tab, fill out the information, and one of our advisors will reach out to you and answer your questions and to give you some perspective on how the market upside, or at least potential upside, could be affecting you and your current portfolio allocation. Thanks again for watching. Bye-bye.